Hi, good morning, Jeff. Thanks for having me. Yes, Chinese equities, especially the tech giants, they seem oversold, but we're not inclined to buy the dip because we see this as a regime change. So I think there will be more uncertainty persisting into the future. And I think the recent actions by the Chinese government in terms of the cybersecurity review, in terms of the tech clampdown, in terms of stating that the education sector should be non-profit, I think that's really wake up call for investors because I think previously investors have been quite complacent. They give these Chinese companies the benefit of the doubt, despite, for example, Alibaba's Ant Group failing to IPO last year. But I think now it's quite clear that the government is actually pursuing an anti-shareholder approach, which prioritizes the Chinese government's own agenda rather than the economic growth or the growth of these companies or even championing these tech giants, which they should be pretty proud of. So we're just very cautious in the near term. And aside from that domestic concern, actually, if you're looking at the U.S. listed Chinese tech companies, they will also face pressure from the U.S. authorities because there would be ongoing U.S.-China tensions. So we're just being cautious there.
Well, just broaden that out for us because you mostly focused on China there, and I think everybody can see the arguments and the reasoning. But Asia ex-China, why still cautious there? Because we had, I think, reasonable PMIs out of Japan and Korea. Can they not make forward progress this month?
Yes. So basically, our stance is that we're marginally positive, but it's not one of our key overweight regions globally. So we have a more cautious tone on Asia Pacific, primarily because of that China's huge weight in Asia. And also we see that the COVID situation continues to be lagging that of the developed economies. If you look at the vaccination rate, which is clearly the key to getting out of this pandemic, it's still really lagging. So we see that the growth trajectory is likely to be lagging that of developed economies. So we feel that there are better opportunities out there in markets such as the US and the Euro area.
Well, Janet, bear with us. I'm just going to bring Juliana into the conversation, who fortunately now the technology seems to be working, is with us for the next 2 hours and 40 minutes. Juliana, good morning.
Good morning, Jeff. Well, thank you for your patience. It's sticking with me. I'm glad we were able to sort it out. Janet, great to speak with you this morning. Interesting you talk about what's happening in China as a regime shift, something that's going to be a lot longer lasting and that investors need to think about when it comes to allocating money. Where do you see that money going that is coming out of these Chinese tech stocks? Do you think that it's going to transfer to US tech, for example?
Hi, Juliana. Thanks for the question. Yes, we feel that the growth style trade is kind of back on after treasury yields have fallen to lower than 1.3%, and we think that the Federal Reserve will remain very dovish, and there's still a lot of liquidity out there. And with growth peaking, I think investors will be looking for growth style stocks, which obviously the U.S. tech shares will offer you that. And the tech giants in the US are more defensive. They offer you growth, they offer you quality, they offer you, more stability and predictability in terms of earnings. So we believe that more money could be going into the US tech sector, as you mentioned.